Have you ever wondered why money sometimes disappears faster than it arrives? One moment your bank account looks healthy, and the next it feels like something quietly drained the life out of it. Many people assume the problem is poor discipline or careless spending. But in reality, the real issue is usually something much simpler. There is no financial cushion. When life throws a surprise your way, and it always does, most people have nothing standing between them and panic. A car repair, a medical bill, or even a short period without work can instantly throw an entire budget off balance. Without a buffer, every unexpected expense becomes a crisis that has to be solved with stress, borrowing, or high-interest credit cards. That is why many financial planners quietly emphasize a simple milestone: having a meaningful amount of liquid cash available at all times. Not money locked away in risky investments. Not funds tied up in property or long-term accounts. Just accessible, stable cash that can be used within a day or two if necessary. For many households, a powerful turning point happens when their accessible savings reach around $20,000. It is not a magic number or a strict rule. Instead, it acts like a psychological and financial checkpoint. Once someone reaches that level of savings, everyday financial decisions begin to feel very different. Before reaching that point, most people are constantly reacting to problems. After reaching it, they begin to operate with options. Emergencies stop feeling like disasters and start looking like manageable inconveniences. The real power of this milestone is not the money itself. The power comes from what that money represents: time, breathing room, and the ability to make thoughtful decisions instead of rushed ones. To understand why a strong cash buffer changes everything, we first need to look at how most households actually operate. On paper, many people appear to be doing fine. They have steady income, they pay their bills, and their lifestyle seems stable. But beneath that surface, the margin between income and essential expenses is often extremely thin. Imagine someone earning around $5,000 each month after taxes. At first glance, that sounds comfortable. But when the numbers start stacking up, the picture changes quickly. Housing alone might take $1,800. Insurance for health, car, and other basics could add another $300 or more. A car payment or small loan might pull $400. Groceries, transportation, utilities, and phone bills quietly consume the rest. By the time everything necessary is covered, there might only be a few $100s left. And that is during a perfect month, one where nothing unexpected happens. But real life never runs on perfect months. A simple dental issue, a broken appliance, or a surprise travel need can instantly wipe out the small remaining balance. When that happens, the easiest solution becomes a credit card. At first it feels harmless, just a temporary bridge until the next paycheck arrives. Unfortunately, that bridge often leads to a cycle of interest payments that quietly grow over time. This is exactly where a large emergency buffer changes the story. When several months of essential expenses are already sitting in accessible savings, those same problems lose their power to create chaos. Instead of scrambling for solutions, people simply use the cushion they have already built. And that shift, from reacting to planning, is where real financial stability begins to appear. A solid financial cushion does more than cover emergencies. It quietly changes the way people think and behave around money. When someone knows they have several months of essential expenses already saved, everyday decisions start to feel less pressured. Think about job situations for a moment. Without savings, losing a job can feel terrifying because bills do not pause while someone searches for work. Rent, food, utilities, and insurance continue arriving every month. In that situation, many people accept the first opportunity they find, even if the job pays less or leads nowhere long-term. But when a person has a reliable emergency reserve, the situation looks different. Instead of rushing into the first option available, they gain time to evaluate better opportunities. They can look for a role that fits their skills, negotiate their salary with confidence, or even take time to learn something new that improves their future income. This same effect appears in many other areas of life. Someone with a financial buffer can move to a better neighborhood, change careers, or start a small side project without feeling immediate pressure. The money in the account creates breathing room that allows thoughtful decisions instead of rushed reactions. Another important benefit is emotional stability. Financial stress is one of the most common sources of anxiety in modern life. When every unexpected bill threatens the monthly budget, even small problems can feel overwhelming. However, once a few months of expenses are already covered, the mental weight begins to lift. Bills are still important, of course, but they no longer feel like an approaching storm every single month. And this calm mindset often leads to better financial choices over time. So if a financial cushion is so powerful, the obvious question becomes simple. Why do so many people struggle to build one? The answer is rarely laziness or lack of intelligence. More often, the problem comes from everyday financial friction. Modern life constantly encourages spending while making saving feel slow and difficult. One major factor is lifestyle inflation. When income increases, spending often grows with it. A small raise turns into a nicer phone plan, a more expensive apartment, or more frequent dining out. None of these changes seem dramatic on their own, but over time they quietly raise the monthly baseline. Another challenge is comparison. Humans naturally measure their progress against the people around them. When friends upgrade cars, move to larger homes, or travel frequently, it becomes easy to feel like staying modest means falling behind. That pressure pushes many households to spend more than they originally planned. Then there is the simple reality of irregular expenses. Birthdays, car maintenance, medical visits, school costs, and unexpected repairs appear throughout the year. Even careful budgets often forget to include these scattered expenses, which slowly drain whatever savings people manage to build. When these factors combine, saving money begins to feel like pushing a heavy object uphill. Progress happens, but very slowly. This is exactly why having a clear financial milestone matters. Instead of saving vaguely with no defined target, people focus on reaching a specific safety level. A concrete goal transforms saving from a vague intention into a measurable mission. Once a clear savings target exists, the process of building it becomes far more practical. The first step is understanding exactly what essential expenses really mean. Many people mix necessary spending with lifestyle choices, which makes planning confusing. Essential expenses are the costs required to keep daily life stable. These usually include housing payments, basic groceries, utilities, transportation, insurance, and minimum debt payments. They are the bills that cannot easily disappear without affecting stability. Everything else falls into a different category. Entertainment subscriptions, frequent dining out, luxury shopping, and spontaneous purchases may add comfort to life, but they are not essential for survival. Separating these two groups gives a much clearer picture of where money actually goes each month. Once that baseline is known, the next step becomes automation. Relying on willpower alone rarely works for long. When money sits in a checking account, it tends to slowly disappear through small, unplanned purchases. Automation solves this problem by removing the decision entirely. Instead of waiting to see what remains at the end of the month, a fixed amount moves into savings as soon as income arrives. This approach quietly prioritizes the future before daily spending begins. Even small automated transfers create momentum. Over time, the balance grows steadily without constant effort or stress. This system may not feel exciting in the beginning, but its strength lies in consistency. The goal is not to create a perfect month. The goal is to create a financial structure where progress happens automatically, even when life becomes busy or unpredictable. After automation is in place, The next step is expanding the gap between income and expenses. This gap is the fuel that allows savings to grow faster. Many people assume the only solution is extreme frugality, but in reality, small strategic adjustments often make a big difference. One effective approach is reviewing fixed costs. Fixed expenses repeat every month, which means even a small reduction can create long-term impact. For example, renegotiating an insurance policy, switching to a more affordable phone plan, or canceling an unused subscription can free up money without changing daily habits very much. Another area worth examining is transportation. Car payments, fuel, maintenance, and insurance can quietly become one of the largest expenses in a household budget. Even small improvements, such as driving a car longer before upgrading or reducing unnecessary trips, can slowly strengthen the monthly financial gap. Income also plays an important role. While cutting expenses has limits, increasing earnings can expand possibilities much faster. This does not always mean working endless hours. Sometimes it involves picking up occasional freelance work, overtime shifts, or using an existing skill to generate small side income. When both strategies work together, lower fixed costs and slightly higher income, the monthly savings rate can grow significantly. What once felt like slow progress can suddenly accelerate. At that point, the savings journey begins to feel less like a struggle and more like a system quietly building stability in the background. As the savings balance grows, something interesting begins to happen. The timeline between financial problems and solutions starts to stretch. Instead of reacting immediately to every expense, people gain the ability to pause, think, and respond carefully. This extra time is more valuable than it might seem at first. When financial pressure is high, decisions are often rushed. People may sell investments too early, accept unfavorable job offers, or borrow money under stressful conditions. These choices usually solve the immediate problem but create bigger issues later. A healthy cash reserve changes that pattern. With several months of expenses already covered, financial setbacks no longer demand instant action. If a job situation becomes unstable, there is time to search for a better opportunity rather than accepting the first option available. If markets fluctuate, investments can remain untouched while they recover. This is one of the quiet advantages of having a strong financial base. It does not just protect money, it protects decision-making. Another benefit is flexibility. Life rarely follows a straight path. People sometimes want to learn new skills, explore different careers, or relocate to improve their quality of life. Without savings, those transitions feel risky and uncertain. But with a financial cushion in place, change becomes easier to consider. The purpose of building savings is not simply to accumulate money. The deeper goal is to create room for better choices and more thoughtful planning over time. Reaching a strong savings milestone does not mean the journey is finished. In many ways, it is actually the beginning of a more strategic phase of personal finance. Once a reliable emergency reserve exists, the focus can slowly shift from protection toward long-term growth. The first priority is keeping the emergency fund separate and untouched. This money should remain in a safe and accessible place, such as a high-yield savings account or a similar low-risk option. The purpose of this reserve is stability, not investment returns. After that foundation is secured, new savings can begin moving toward assets that have the potential to grow over time. Many people choose broad market investments because they spread risk across hundreds or even thousands of companies rather than relying on the success of a single business. The key principle here is diversification. Instead of trying to predict which individual company will succeed in the future, diversified investments follow the overall growth of the economy. While markets can rise and fall in the short term, history shows that long-term participation often rewards patience. Costs also matter more than most beginners realize. High management fees can quietly reduce investment growth over many years. Choosing low-cost investment options allows more of the returns to remain in the investor's own account. At this stage, financial progress becomes less about reacting to emergencies and more about building steady momentum for the future. The emergency fund protects stability, while long-term investments begin working quietly in the background. Another important idea to understand is that income alone does not determine financial stability. Two people can earn the same salary and still experience completely different financial outcomes. The difference usually comes down to living costs and spending structure. Consider two individuals who both take home around $6,000 each month after taxes. On the surface, their financial situations look identical, but where they live can dramatically change how far that income actually goes. In a high-cost city, housing alone might consume more than half of that income. Rent, transportation, groceries, insurance, and utilities can quickly push essential expenses close to the full monthly paycheck. In that situation, saving money becomes extremely difficult, even with careful budgeting. Now imagine the same income in a more affordable city. Housing might cost far less, and other expenses like transportation or insurance could also be lower. Suddenly, there is room to save a much larger portion of each paycheck without dramatically changing lifestyle choices. This example highlights an important lesson. Financial planning should always focus on essential expenses rather than just income levels. The real question is not how much someone earns, but how much of that income remains after covering the basics. When essential costs stay under control, building a financial safety buffer becomes much more achievable. And once that buffer exists, the path toward long-term financial stability becomes far easier to maintain. Finally, the journey does not end with reaching the initial savings milestone. Once a solid emergency fund is in place, the next steps involve maintaining stability while steadily growing wealth. First, the emergency fund should always remain intact. Treat it as untouchable, reserved only for true financial shocks, job loss, medical emergencies, or other unavoidable expenses. Using it for lifestyle upgrades or impulsive purchases defeats its purpose. Next, any high-interest debt should be prioritized. Paying off debt with double-digit interest rates is effectively a guaranteed return on investment, far better than most speculative ventures. Once debts are under control, additional funds can flow into long-term investments like low-cost index funds, Roth IRAs, or employer retirement plans with matching contributions. Automation remains key throughout. Continue directing income towards savings and investments before discretionary spending occurs. Windfalls, bonuses, or tax refunds should also be used strategically to accelerate progress. Over time, the combination of a protected emergency fund, consistent investing, and disciplined financial habits compounds into real freedom. Life no longer feels dictated by small emergencies or unexpected expenses. Career decisions, side projects, relocations, and other opportunities can be approached deliberately rather than out of necessity. The $20,000 milestone is not a magic number. It is a framework. It converts uncertainty into predictability, stress into calm, and time into choice. It teaches that financial security is less about sudden wealth and more about consistent, intentional actions. By focusing on essentials, automating savings, growing the gap between income and expenses, and investing wisely, anyone can move from reactive financial stress to proactive stability and growth. The journey is gradual, but the results, confidence, flexibility, and freedom, are profound.